Good morning. My name is Opoku-Agyemang. I work with Blackstar Brokerage. I welcome you to the first BSB Investor Webinar Series, and we are glad that you've joined us today. It's going to be a 3-day section for various participants in the financial sector, and the grand theme for this program is reliability in times of uncertainty, making investment decisions while transitioning from a pandemic and financial sector reforms. These are things that we are all familiar with, and we are just coming to do an in-house, an industry conversation among industry players to see how we all survive and thrive within these challenging times. We've been honored to have two guests of honors for this program. And we have Mr. Sampson Akiligoh. He's the director responsible for the Financial Services Division of the Ministry of Finance. And we also have Mr. Ekow Afedzie, the managing director of the Ghana Stock Exchange, who will join us in a jiffy. For today's section, it's organized for the players of the investment management sector. So we will have trustees and fund managers. And we are glad that this is happening on the back of last week's insightful workshop that was organized by the Ghana Stock Exchange for market players. So we are just picking it up from where we left off. And we are also honored to have 3 great speakers to be on today's program to share thoughts with us in line with the theme and how we progress. So we would have presentations from Mr. David Tetteh-Amey, who is the Deputy CEO of the NPRA. We also have presentation from Mr. Paul Ababio, who is the Deputy Director General of Securities and Exchange Commission. And we will finally also engage with Wiafe Boamah, who is the Chief Investment Officer of Access Pension. As your host, let me give you a bit of housekeeping tips. What we will do is our various speakers will give their presentation. Then we will ask some 1 or 2 questions. Then we'll move to the next speaker, and it will be repeated until we are done with the last speaker. Thereafter, we will do the final Q&A section. But during the course of the program, if it happens that you have a question, you can write it down or you can type it in the Q&A section so that the team will pass it on and for us to relay to the respective speakers. So once again, I welcome you to the webinar series, and feel free, let's share thoughts for the common good. I will now hand you over to my colleague, Emmanuel Kujo, who is head of our securities trading, to introduce our guest of honor for them to give their keynotes. Then we will kickstart the program. Thank you.
Thank you very much, Nana. The first keynote speaker for today is Mr. Ekow, the MD for Ghana Stock Exchange. I think he's taking time out of his schedule to be.
Hello, Ajo. Yes,
so he will have 5 minutes to give a keynote.
Okay, all right.
For the webinar, then after
Mr. Afedzie first. The minister is speaking to Sampson.
So, Mr. Afedzie, good morning. If you can hear me.
Can you hear me?
Yes, sir. I can hear you now. Good morning to you.
Good morning. Unfortunately, I might not show my face.
Right. I think hearing your voice is satisfactory enough. So I'll hand over to you for a quick keynote for the program to begin.
Okay. Let me first of all say good morning to everyone. I hope you can all hear me very well.
Yeah, I can hear you. I can hear you. I believe everyone can hear you as well.
Special greetings to the Deputy Director General of SEC, the Deputy CEO of NPRA, the Director of Financial Services will join us later on, and all the invited guests. On greetings from Ghana Stock Exchange to all of you. And let me start by commending Black Star Brokerage for this laudable initiative of investing, of organizing this workshop, which is meant to engage players and also the investing public. And we're hoping that with this to support the growth of the market, and we're also hoping that as we gear up and trying to recover from what is happening in terms of the COVID environment, such decisions by the brokerage firms to organize such webinars to get the investing public and the other stakeholders to understand what's going on in the market is very important. The team is very apt. Reliability in terms of uncertainty, making investment decisions whilst transitioning from a pandemic and financial sector reform could not have come at a better time than this, when the investors and businesses are very cautious of their investment decisions as a result of the environment we live in. Though confidence in the market is gradually coming back, growing slowly, there's still a lot of work to be done, especially in the equity market space. In the bond market, we've seen a lot of growth in the bond market, but then we need to make sure that in terms of the equity market, we can still get a lot more investments into that area. Brokers have a critical role to play in championing investor education to influence investor behavior in this country. This move by Black Star Brokerage is therefore a step in the right direction that should be emulated by other brokers and players in the industry. If we're to be having a fiscal meeting, I would have asked everybody to clap for Black Star, but I'm sure people can still give you a shout for this innovative thing that you're doing today. So it is important for everybody to note, and especially the brokerage firms, that the stock exchange is prepared to collaborate with them to organize such programs in order to build the savings and investment culture in this country. Without the savings and investment culture, it's going to be difficult to accelerate the development of this nation. So it's important that we continue to educate investors and also entrepreneurs in terms of raising long-term capital in order to accelerate the growth of the development of this country. With these few remarks, let me say welcome to everybody and wish everybody a successful webinar. Thank you very much.
All right, thank you very much, the MD of Ghana Stock Exchange. And indeed, it's refreshing to also hear from you that you can also realize that the market is really picking up, regardless of the fact that there's a bit of uncertainty, not just COVID, but we also had a very necessary exercise from the government and the Bank of Ghana in making sure our financial sectors are very strong enough. So we had that uncertainty coming from the exercise and also COVID as well. And it's refreshing to hear the market is picking up. And hopefully by the end of this webinar, a lot of the players will also turn their eyes to equity as well, not just fixed income, as you rightly said. Thank you very much for your keynote speech. The next person that would also give a keynote speech is Mr. Sampson Akiligoh, who is coming from the Ministry of Finance, who happens to be one of our, I should say, the largest issue of fixed income securities in Ghana at the moment. So without taking much time, we'll also give him 5 minutes to give a keynote speech. So I'll hand over to Mr. Sampson Akiligoh.
Yeah, thank you very much. And thank you, Nana, for for the invitation. I really appreciate it. And I think that the events like this are very important in positioning the capital market as really the epicenter of the financial system. And therefore, I have no doubt that we need to actually do more of these things and get more people to get involved, so that as a country, people can get a holy sense of the capital market. Essentially, we are having this webinar at a very important time in the recovery of the financial sector and also the capital market. Over the last 4 years, the capital market performance has been quite tough, especially in the equities market. But when we look, for example, at the year-to-date performance of the GSE, it's quite clear that a lot of progress have been made, and the recovery effort is even stronger than anticipated. It's clearly we should capitalize on this and get people to be more excited about the equity market. In terms of the fixed income market too, the deepening in the market is still ongoing. And as you said, government has led the effort. What is important is that we must find a way to also use these benchmarks provided by government to get the private sector to actually come into the fixed income market. In terms of the proportion, it is woefully inadequate. And I think that the measure of last resort will be how much fixed income activities that corporate issuers undertake through the GIFM. Essentially, once I make these few remarks, government has been in a pole post to see what we can do to support this. As you know, we just launched the Capital Market Master Plan, and this master plan was launched in response to the needs of the country. The country today really needs growth, needs jobs, and needs infrastructure. And there is no angle of the financial sector that is well positioned to do this. Our ability in the capital market to do that becomes therefore a sole responsibility that we owe the Republic. How do we then do that? Under the Capital Market Master Plan, a couple of initiatives have been underlined to see how we can speed up the process of deepening the capital market. I think I will go through just a few of them. And I'm going through this within the context, as we know, that when it comes to the usage of funds in the capital market, we are still woefully underperforming, even if we compare ourselves internally. How do we, under the 4 pillars of the Capital Market Master Plan, improve diversity of investment products and liquidity of securities of the securities market? How do we increase the investor base through broad education and targeted intervention? How do we strengthen infrastructure, improve market services? And how do we improve regulation, enforcement, and market confidence? And along with enhancing the use of technology, both by market players and the regulator. All these are very, very important if we look at the future that is required for the capital market to be that role. Today, we are about 15% of GDP. That 50% of GDP is not enough to put us in a position that we can lead economic transformation. At the same time, when you look at the needs of the country and you compare us to, for example, typical checking accounts, my understanding is that when you see the number of people who own mutual funds in Ghana, we are talking about, at best, over 200,000 people. And when you compare that to the number of people who even have bank accounts, clearly, you see that this segment of the economy is not performing well. But how do we really get our people to know and to own the process of knowing that providing patient capital through these institutions is how our businesses can get funding for the long term, is how our private equity funds can grow, and how do we really harness that? Another conversation is the impact of the pensions. I think we have mentioned the pension funds over and over again. We know that the pension funds are not impacting the equity market. In fact, I was even having a conversation where I said that even the role of SNIT in the capital market in terms of equity has been very phenomenal compared to the private, more like the deregulation or whatever of the pension ecosystem. So we need to find a way for the corporate trustees to know that when we have one entity, SNIT, and is able to have a bigger impact on the equity space, patient capital there is no way that we would open up the space and then we are even having a limited impact of pension funds. And so if pension funds are not in a position to take advantage of prices, to look for underpriced securities and get fund managers to be responsible for taking those investment decisions and thinking long term, then that is a very difficult conversation for reforms in terms of the capital market. How do we use conversations through this webinar to really champion that? We do understand that the pension funds have on the back of them retirees, but we also understand that this model, this framework has worked in a lot of countries, and that is even the basis of the pension reforms. So it is just important that as a country, we take advantage of it. So I would end by challenging you that, look, let's have a conversation that positions us to take the capital market forward. Let's take advantage of the capital market master plan. We have provided some funding under the capital market plan. It might not be enough. I understand the funding gap is about 300 million cedis, but I can say that so far we have provided about $6 million under the World Bank project to support the implementation of the capital market plan. We have also made an additional allocation of 1.7 million through an AFDB project to also enhance the supervisory framework for the SEC. We are also working together with the regulators, and recently a conversation with the stock exchange on the possible establishment of a domestic credit rating agency. The idea is very clear to us at the policy level. You know, we have worked with the SEC to develop an ecosystem for credit rating agencies, and that ecosystem is for everybody to come and play. But we also think that looking at our history and the lessons from the financial sector cleanup, there must be a base credit rating in the economy, so that which is more like mandatory for key financial sector institutions and products to subscribe to, and that would be like a baseline. And for some, based on policy conversations, we should have a way that, for example, mutual funds will be rated. And so these conversations are important for the future of the development of the capital market. So we will look forward, especially from the Ministry of Finance, to continue to have market dialogues like this. That gives us the ideas, the innovation, and the partnership that is required to take the capital market to the next step. And thank you so much. And I wish you all the best during the webinar session. And God be with you.
Thank you very much, Sampson, and thank you to Mr. Afedzie as well. We are grateful for your presence and your insightful comments and keywords. And I think Sampson has really set the tone for the dialogue, and I think it's going to improve. Whilst he was speaking, I realized that he made reference to the fact that the equity market has crossed 30%, and the fact that SNET has even been much more active in the equity market as against the private pension scheme. So I think the man from the top echelon of our industry, the financial sector, is giving us some hints of what they expect from us. So it's going to set the ball rolling. I would then let us move on to the next stage of the program, where our key speakers for the day will speak. And there are three of them. My colleague Emmanuel will introduce the first speaker, and they will also take up their presentation. Then we engage there afterwards. So Emmanuel, kindly take over.
Right, thank you very much, Nana. And before I introduce the next speaker after Mr. Akiligoh, I think one thing he said, getting to the end of his keynote, was what the government is doing to support the regulators to make sure we all together work to deepen the market, and importantly, bring the corporate side of the issuances to the market. Because currently, when I'm doing transactions for clients, a lot of the demand is mostly towards the government of Ghana securities, which in itself doesn't help. But when you get the corporate entities coming on the market and issuing papers, we are able to direct capital to the corporate side, and we get the capital to where the sector of the economy where it needs a lot of the capital as well. And without wasting much time, we have speeches, or we're going to have a presentation from two of our main regulators, and these two regulators are very important to the audience we have, which we believe are largely pension fund managers and mutual fund managers. So the first speaker is Mr. David Tetteh-Amey from NPRA. He's the Deputy CEO of NPRA. So he is going to handle the topic on the role of the pension regulator in ensuring effective investment decisions and administration of pension in the country in a period of a transition. So Mr. Abbey, if you can hear me, good morning, sir.
Yeah, good morning. Can you hear me?
Yeah, I can hear you. I can hear you. So I'll hand over to you for your presentation.
Okay. Let me see. Okay. So thank you very much. I just want to make sure that I have the right slide on the screen. Since you invited me, I've been working on making sure that this presentation goes very well. So forgive me, just a second. But I've listened to the my colleague who spoke not long ago. We all worked at Data Bank together, so it's been a while. But before I bring on my presentation, I heard him touch on certain things that my presentation will try to situate it very well to make this conversation more relevant. For example, looking at the Capital Market Master Plan, he looked at regulation and enforcement and market discipline. Very, very key. As a regulator, the NPRA is trying all it can, as the law enjoins us to do, to make sure this thing is done and work towards the government making sure the Capital Market Master Plan works. And then he also made mention of the use of technology. I can also assure him that we are in the process of acquiring a pension market surveillance system that we believe that will help us move from a compliance-based supervisory regulator to a risk-based supervisory regulator, which is what is happening globally, so that we can make judicious use of our resources and make it more effective. And the use of technology has also come in handy given the pandemic. And as the team is looking at how we have evolved because of the pandemic, I just want to assure him that the NPRA is also evolving like that. And very soon we'll be able to look at our technology and deploy it. He also spoke about diversify and deepen the capital market. As my presentation will show, I'll try to put certain slides on as far as the investment guidelines and then the available universe of securities that the NPRA is expecting pension funds to invest in. They also mentioned of the provision of patients' capital. It is very, very key, and the responsibility is always on the pension funds who have long-term investment objectives in mind to make sure that they provide the patient's capital that is required. In the investment guideline that I will showcase, we will see how the market or the regulator is pushing the market to ensure that pension capital is provided. We as regulators can only show the signal. We will signal the market where we think our regulatory entities must go. But a lot of the time, many are of the opinion that we need to intervene and actually set investment floors, set floor here and there. But we believe that that will be too much of intervention. But we will continue to give the ceilings and the nudge and encourage pension regulatory entities to do the right thing. I was at the Ghana Stock Exchange workshop recently, and I made those things very clear. He also compared how SNIT has been very dominant in the capital markets as against the private managed schemes. Sampson, I must say that SNIT has been there for several decades. SNIT has built the competencies. SNIT have had very good management systems and personnel that have taken them very far. And I remember when the stock exchange started, at a point in time, SNIT had about 90% of all listed equities, but even right now they've diversified some of them onto the market. So I believe that the privately managed pension schemes are not even 10 years old, because MPR is 10 years old and we got established before we even licensed them. But I believe that with such webinars and the workshop that the stock exchange organized, Mr. Afedzie can testify to how positive my CEO, Mr. Ifoda Takrofi, and myself and the management of MPRA are eager and encouraging pension trustees to ensure that fund managers take the right decision on long-term capital. The funding gap, we also made it clear that given the 22 billion assets under management that we have as at December 31st, 2020, and the fact that we have given a ceiling of about 20% to be in the capital market, we only realized that only 3.7%, which is about 850 million, is being invested on the capital market. And the question is why? And I think the Ghana Stock Exchange, in collaboration with the MPRA, we organized a workshop for trustees, fund managers, and brokers to dialogue and then answer those questions. And I think it's the Afedzie and then Abina, who are all here, will testify to the fact that we came out with some communique that will help government in the policy making and maybe help. The Credit Reference Agency is a welcoming news, Sampson. It's been long overdue. I remember when I was in the bank, we had a couple. There was a law that was passed. We had a couple, but I don't know how effective they are as far as the credit, because a lot of the time when you want to take a loan, we usually require feedback from these agents. I think there were two. So if government is taking it very seriously, it will go a long way to also help pension funds to do the right thing. So sorry, I didn't observe the protocols, but I want to take the protocols that Mr. Ekow stood upon, my senior brother in the market, to observe it, and so that I can continue with. But I thought I should just give some assurance to Sampson and the finance minister that the MPRA, as you will see in my presentation, we are trying to ensure that the capital market strategy that they have put together performs. So Sampson, this is for you. Now, the role of the pension regulator in ensuring effective investment decisions and administration of pension funds in the country in a period of transitioning, it's a very, very good thing, and it has come in handy, where since 2017, there have been financial market reforms. Nobody was expecting COVID, but COVID came, so it was like a double whammy. And the question you ask yourself, how has the market been able to take the shock, and how did it affect the pension space, and how has the regulator ensured that lessons have been learned, and what were some of the things that the regulator put in place and how far have we gone in making sure that policy and regulation will be directed in a different way, given the way the world has come. That is the way my presentation is structured. We will look at the banking sector cleanup and the reforms. We'll look at the impact that it had on the pension space. We'll look at the impact also that the revocation of fund manager licenses also had on us. And then we'll look at the impact of the COVID. The impact of the COVID, that was very global, and that is the biggest shock, I think, that came to us. And then finally, we'll look at the transition and the recovery, and then the outlook. Let me share. Okay. Can you please see my screen? Mr. Moderator, am I sharing my screen, please?
Yes, I can see your screen.
Thank you.
I don't know if you can hear me.
Yeah, I can hear you.
Sure. So if you could please take to slideshow view.
Okay. All right.
And yeah, as Mr. Abbey fixed that, if you have any question from our audience, you can always drop it at the Q&A button on the Zoom call app. So then we will know them and direct the questions to them. Also, we would like to acknowledge that Mrs. Abnamwa is on the call. She's Deputy MD of Ghana Stock Exchange. So, which means we have a wider coverage, and I should say we have important people on the call who would listen to the discussion and raise various concerns that would help the industry as we try to transition from these two actually on events that has brought some level of uncertainty to the market.
Okay, thank you very much, Mr. Moderator. As I was saying, since 2017, the industry have experienced 3 major events which has affected the pensions industry. These are the banking sector cleanup, the fund manager license revocation, and the COVID pandemic. So this presentation will take a look at the impact of these events and how the MPRA as a regulator is transitioning to lower the impact. First and foremost, the Bank of Ghana, and rightly so, embarked on the banking sector cleanup, recapitalized other regulatory reforms from mid-2017 to December 2018, in line with its mandate to promote safety, soundness, and stability of the financial system to support economic growth. The Bank of Ghana revoked the Class 1 banking license of 9 banks. This is history. UT Bank, Capital Bank, Sovereign Bank, Beige Bank, Premium Bank, Royal Bank, Heritage Bank, Construction Bank, and Unibank. Then 6 banks were merged into 3 banks. First Atlantic Merchant Bank and Energy Bank merged. Omni Ghana and Bank Sahara also merged. And then First National Bank and GHL Bank also merged. So this brought some form of consolidation to the market, but it also affected our industry as well. Now, a lot of the banks decided to reprice interest rates that they took over from the inefficient banks which were affected. And most issuers of security, mostly fixed deposits, these banks are also issuers of security, and some are custodian, but they are pension fund custodians. I will explain the impact that a pension fund custodian, who is also an issuer of fixed deposit, had on the pension scheme. Most issuers of securities, mostly fixed deposits, reduce their investment and reduce the interest rates that they have inherited. So it resulted in a decrease in investment income. I personally have to get involved with, for example, CBG. As some of you saw me there, we had breakfast meetings with CBG, just trying to make the point that, look, you can't just drop it like that. And some of them also delayed in paying. I remember CBG was trying to issue bonds. All of these things affected the investment that pension funds have made. There were less options to invest among the issuers of fixed deposits. There was panic. So a lot of trustees started requesting the regulator to give them the option or to give them the approval to exceed the limit in government securities, because they were afraid to invest more into the banks whose fixed deposit they are not even able to get. They were not in the position to bargain interest rate, because it is like you have made a bad investment decision by buying a security from an issuer that is not having good basis. So buyer beware, as the law will say. You need to have done your research. You need to have done your work very well so that you don't have gone into this mess. So a lot of them lost their moral authority to engage and bargain as they used to do. Then expected maturity date were rescheduled to later date. And this is expected to happen because if GCB have taken over Capital Bank and UT Bank, you don't expect him to immediately be paying fixed deposit, because there will be a run on those banks and he wouldn't like to transfer that run onto his books as well. So a lot of them on maturity, they will say that take it easy, we are working to restructure the new bank that we've acquired. CBG also requested that we should give them time. All these things affected pension fund. Some short-term investment portfolios were converted to long-term, in the sense that if you don't have any option, then you need to comply. That look, you go into a 91-day treasury fixed deposit, and now the company has been acquired, and they say we issue you a 5-year bond. You just needed to take it like that. What happens is that it will change your portfolio structure, and it has consequences. Now, in November 2019, I was speaking about three shocks. In November 2019, the Security and Exchange Commission also withdrew the licenses of 53 farm managers. These actions were taken pursuant to Section 122 2B of the Security Industry Act 929 to protect the integrity of the securities market and investors. Now, we had collective investment schemes as part of our allowable or permitted investment. Some of these fund managers were the sponsors and managers of these schemes who have also issued or who manages these collective investment schemes. It also had a similar effect. And as you are aware, we also realize that some of the fund managers, in placing money with banks and things, they have mixed their own money with that of the pension funds. And so when the regulator wanted to move in to save the pension funds, a lot of legal issues came up that, look, we don't know that pension scheme on our books. It is the name of the fund manager that we know. And some of the fund managers have also used it to collateralize loans and all those kind of things. These were issues that came to the fore that the regulator had to quickly deal with it. Now, a lien was placed on most of the revoked fund managers of which pension funds was misconstrued as assets of the manager, and that is what I have just described. And it was a bad time for us as regulators, and it was an awakening because we thought we were cleaning up after the bank, the financial sector were cleaned out. Then this one hit us. Reinvestment plans of pension funds were also affected. Some pension funds had also invested in not allowable securities in some of these companies, and it was affecting the entire portfolio of the scheme. And trustees were very, very worried because they are the fiduciaries. What are they going to tell their pensioners who are retiring? And it brought fear into the market. As an experienced investment banker, I had to even sit in meetings to look at the restructuring of some of these schemes and then repricing. And it was not a funny experience at all. Now then came COVID in 2020. So 2017, 2018 was the Bank of Ghana trying to clean up the system based on its mandate. Then 2019, the Security and Exchange Commission was also trying to clean the market based on its mandate. And one thing that we should all be aware is that we, as pension fund regulator or the pension fund industry, relate to all of the other regulators, with National Insurance Commission, with Bank of Ghana, with the Security and Exchange Commission. The financial security system was so integrated that we didn't even, maybe we're taking that for granted. But I must say that one of the good things that you see that happened was the Financial Stability Council, which was a good policy that the Ministry of Finance and its partners instituted. And I think we have been collaborating. And some of the resolutions that I'll discuss later on in my slide was as a result of that collaboration among the financial security regulators, NIC, SEC, NPRA, and the Bank of Ghana. Now, the impact of COVID. So 2017, 2018, 2019, SEC came, and then 2020, when we thought we were calming down and solving it, then COVID came. Now, the first hit of COVID was the decline in contributions. Some employers laid off workers temporarily. Others had to close down for some time. For example, the hospitals and schools. This resulted in the decline of projected contributions because, I mean, they cannot pay salaries, how much more pension contributions? And this, we shouldn't forget that as deposits are the lifeline to a bank, so are investor contribution to a pension scheme. Let me repeat that. I'm saying that as long as deposits continue to be the lifeline of a bank, so are contributions to a pension scheme. So here we are, the employers are suffering. They've closed down, they have laid off workers. Contributions provide liquidity to the pension scheme, the same way deposits provide liquidity in dime, and it is a cheap form of liquidity. Unfortunately for pension scheme, they can't borrow. We don't allow them to borrow on the back of the scheme's balance sheet. Unlike the banks, when I was the treasurer of Fidelity Bank, we could borrow on the interbank market to support the books when the deposits are not forthcoming and we need to pay out. But in case of pension scheme, they cannot borrow. So when the contributions of employees are hit by such an impact, it brings the schemes to their knees as far as liquidity is concerned, and even reinvestable funds. There was also a reduction in investment income, rising from basis point cuts on treasury bills. The Ministry of Finance tried to encourage cuts in the treasury bill portfolios of investors. We were able to engage the Bank of Ghana, the Ministry of Finance on this issue. Then Bank of Ghana also directed that banks should hold on to payment of dividend. Now, if you are a pension fund and you've invested in equities of banks and they are not paying dividend, it can also affect liquidity. I know that they are not obliged to pay dividend. They can declare and pay. But if they don't declare, you can't force them. But when there was a regulatory ban on it, it also affects the flow because like I've explained, pension funds, when they invest in equity, it's not necessarily about capital gains entirely. But at times, the dividend also help them to pay retirees when they are leaving. And then increase in withdrawals from the third year. We all know that with the third year, it's a voluntary scheme. And the third year is 60.5% tax-free as compared to the tier 2, which is 5%. So if the tier 3 is anything to go by, and all things being equal, you realize that if everyone in the tier 2, which is mandatory, is also doing the tier 3, the tier 3 will be growing more than 3 times the rate of growth of the tier 2 in terms of the contributions. But here was it, because of its voluntary nature, when the shock came, a lot of employees decided to draw down, and they were willing to pay the 15%. And you cannot fault them, because in the political space in 2020, there were politicians discussing using Senate to support employees who have been affected by the COVID. So I think Ministry of Finance quickly said that if somebody is withdrawing because of COVID, they should not be made to pay the 15% tax. And I think it helped to calm the situation. Now, some of the trustees also were not fully operational due to staff rotations that they adapted. And you realize that when the COVID came, there was a lockdown, and then we started working from home, and these were all new things. So it really affected the operations of the trustees. At times, when you even want to do on-site inspection, you cannot even go to the office of the trustee because most of his staff are working from home. And then we also did not want to expose our staff there. So we were all trying to manage a new situation. Now, the authority, as I said, is now a member of the Financial Stability Council. And the status and risk exposure of the financial industry is shared among member institutions. And I've explained that one already. That was one of the best things that happened to help recovery within the sector, because we have reps of the Ministry of Finance on our board, we have reps of SEC on our board, we have reps from Bank of Ghana on our board. So we felt that we could have vetted it, but I realized that information did not come at that level. So now with the Financial Stability Council and the collaboration between the various experts from the financial security regulators, I believe that future shocks like this will be abated. And then the authority also grants investment beyond the threshold in Government of Ghana securities, as I explained earlier when I was addressing Sampson's and strategies for the capital market master plan, I made mention of the fact that because of the panic, a lot of people were asking us to increase the 60% threshold into government of Ghana securities while they manage the shock. But I think since then, the portfolio as at 31st December 2020, the 22 billion, we have about 60.5% in government securities, which is slightly above the 60% threshold. So the rebalancing had occurred, I think occurred over time, but there's still the request on our table where people want to go beyond the 60%. The trustees were also asked to develop a business continuity plan because we realized that the way they were working from home and managing the business was not very efficient. So we requested, including the NPR, to do the business continuity plan. And a lot of trustees have complied, and we are happy to say that we are managing the industry very well. The authority also, under the auspices of the Financial Strategy Council, developed a risk assessment and mitigation plan. This one was discussed at the FSC, and all of us, I mean the 4 financial sector regulators, were asked to identify the risk and then what mitigation plan that we have. And we did very well in doing that. And then, as I said earlier on about the use of technology, we are adapting a risk-based supervision approach for effective regulation and supervision of pension schemes by, we are in the process of acquiring a surveillance software, which we believe that it will make us have real-time interaction with our licensee entities and service providers and ensure that we can avert such things. We are also strictly enforcing the investment guidelines and other laws that we have instituted. As analyzing the scheme audited reports, we realize that certain trustees are even overcharging the scheme, the expense ratio that we set up. Some of them have exceeded it. And these are certified accounts from the auditors. And then some of them have also gone outside the permissible investment. And we are also ensuring that we do that. We are also leveraging on technology for inspection exercise and stakeholder engagement. I must say that through the government agency, NITA, we were able to be on the government smart workplace, the government digitization drive. We were one of the institutions that are fully on it, the smart workplace. We are even on phase 2, where we are trying to digitize some of our processes. And we've also, as I said, we've developed a business continuity plan as well for recently developed a corporate governance code for the industry, also as instructed by the FSC. So this, and what is the outlook? COVID and the 2 other shocks that came into, I called the 3 shocks because they were external to my industry. So I call them shocks. The SEC one, the Bank of Ghana one, and then the COVID. So it changed the future of work. And I think globally, that is the way to go. Automation. And I must say that the Vice President's digitization agenda, I've also seen that we are asking all our schemes to use the national identification number. And SNIT has taken the lead. And then I know that the other trustees, we are working with the corporate trustee chamber to ensure that we use the national ID so that we can speed up enrollment in the informal sector. We can speed up issuance of statements. We can speed up things rather than using the manual process. And we can also use the same thing like we are doing today to reach out and do sensitization and education. We have also reviewed our investment guidelines in line with the Capital Market Master Plan. And who happened to be the chairman of this review than the Director General of the Security and Exchange Commission, Reverend Boamah Tetteh. He chaired the review of the latest investment guidelines of pension fund. And we had representatives from the fund managers, KB, Boamah of Stanley was representing the fund managers. We have Yvonne Opoku-Agyemang from the Ghana Securities, GSI also was there. And then we had members of industry, the trustee chamber. I remember the enterprise CEO, Mr. Ampofo was also there. We went off-site, and then we've come out with a new, that will be the third review that we've had. And there are very nice things there that I believe that there will be market engagement. And then when we have the new board, with their permission, now we've also looked at the diversification of pension funds among the permitted asset classes. We have a lot of, a wide range of permissible asset classes, but we realize that there's so much concentration on government securities and then fixed deposit. They are taking almost 90% of the fund. And I was encouraging the Ghana Stock Exchange to put sales target on the licensed dealing members of the exchange, and then they in turn put a sales target on their authorized dealing officers to bring pension funds to the market. We are on the buy side. You need to sell us things. We don't sell securities or buy securities from the market. They are done by the LDMs and the ADOs, and they need to do a good job by coming to us and making sure that they've sold something good to us, so that we will in turn will be convinced. And that is what I'll tell Sampson, that it is not that the trustees are not doing well, but both trustees and fund managers are buy side. They are not sell side. So the sell side brokers need to up their game. Licensed dealing members are no longer aggressive. I was an ADO for Wiafe grant, and Wiafe grant do not allow you when there is a 4.4 billion potential market for pension fund, and then you only have 850, and you are sitting down. You are sitting down for what? Who try there? I mean, and we also believe that implementation of the corporate governance code will help to improve the governance of this scheme. So thank you very much. And if there are questions, I'm willing to take them. Thank you very much. And congratulations, and Agyei, my good friend, for organizing such a seminar and asking that my CEO releases me personally, because usually our director of prime has been doing a lot of this engagement. But I'm very happy to be here, and I will answer questions. Thank you very much.
I'm so happy to hear from you, and I see how you are really on top of the issues with regards to how you've gone chronologically in outlining all the issues you've had from the various, I should say, the various uncertainties that has hit the market. And if I'm taking a cue from the last statement you made on we the brokers, which I'm a broker myself, so or I work for a brokerage firm, so we the brokers not hitting the pension funds enough with a lot of sales. I have an interesting question here, and the person seemed to say that the person, for him, he thinks the trustees have become so powerful to the extent that when they go to the pension fund managers for a trade, I believe the person is a broker himself, the fund managers tell them that they have limits on the number of people they can deal with. And I also get that a lot, and fund managers are the audience for today. And they can attest to the fact that when sometimes you try to approach them, they tell you, I have my broker already. So we want to hear from you. Is it that our trustees have become so powerful, or you have sent an instruction to pension fund managers to have some limited number of brokers that they can deal with?
You know, I get that question all the time. And when I attend workshops where you have fund managers and then trustees. And one of them was a recent one that the Ghana Stock Exchange organized. And I gave an answer to this question. Let us not be deceived. Under Act 766, as amended by 883, it is the corporate trustees who manage pension schemes. And I'm making it very clear. Section 120 said that only licensed trustees approved by the NPR are the managers of the scheme, which means the scheme may need governance. Now, among the functions that Section 121 imposes on trustees, which if you don't do that, you can even go to jail for a minimum of 10 years for misappropriation, is to secure scheme registration and then appoint fund managers, custodians, and other service providers and ensure their compliance. So if you take the pension industry under 766/883, which governs the industry, the fiduciary responsibilities are squarely placed on the trustees. I don't license fund managers, I don't license custodians in my space. They are licensed under 929, which is regulated by SEC. I only register them when they are licensed by SEC. So I don't want us to talk about who is powerful. There's nothing like powerful. We are all operating in two different industries. One is the pension industry. And if you look at the law, even when it was describing fund managers, he said pension fund managers. Because there are fund managers who are doing mutual fund, like Sampson said, who are doing unit trust. And I always try to educate people because I have operated in all this. I was a treasurer of the bank. I operated at the Bank of Ghana. I was the CEO of Fidelity Securities Limited. I operated under SEC. And when I was a treasurer, we had a custody business, which was under SEC as well. Before I'm now a regulator. So we are all operating under three different laws. Under 929, it is the role of the fund manager to sponsor and secure the registration of the scheme. Let me call the unit trust and the mutual fund schemes. It is their role. And then they intend appoint trustees for, you know, the trustees in 929 is a custodian for unit trust. And then the custodian in 929 is a custodian for mutual fund. So the trustees and custodians under 292 are custodians. And the fiduciary responsibility for securing the scheme registration, setting up the scheme and all those kind of things has been placed on the pension fund manager. So when I was a CEO of a pension fund management firm, as I mentioned, I set up Fidelity Asset Management, which became Fidelity Securities Limited. Now, when you are under 929, the fund manager is the Ogbodo, as we will say in our local language. He puts money and takes money and invests. Under 760 as amended 883, that role has been given to the pension fund trustee, but the law under 146 said that the pension fund, which are the funds of the scheme, will be managed by the fund manager. But in 2014, the there was an amendment to 766 which clarified the management of the funds of the pension scheme as in what advised the trustee on the investment of pension funds. That was a principal enactment which was amended. For what there has been a lot of forth and back on this amendment. I wasn't there. I wouldn't like to begrudge it because it was an act of parliament. That in order to cure this ambiguity, it was amended to be explained that the pension fund managers under 766 are to advise the trustee on the investment of pension funds and assets in accordance with the provisions of this act, and advise the trustee on the investment of pension funds in different investments to minimize investment risk. So these were some of the functions that when 146 introduced pension fund managers, 147, which was talking about the functions, clearly stated as amended. So there's no ambiguity. And then it went on to say that pension fund, a pension scheme asset can only be held by pension fund custodian. I think that was 176. So the governance structure of the pension industry has been enshrined in law. And I said it last Thursday when Mr. Afedzie and his team invited me. I made it very clear that the governance structure in 766 as I made it 80 is different from 929. And let us not mix it before we create problem. Look, the same problem can happen between SEC licensing banks as custodian banks, and then Bank of Ghana also licensing the banks. And if we don't cure it here, the same problem can go on with the banks. When the financial crisis hit, a bank like Unibank, who was also a custodian bank of pension schemes, Bank of Ghana appointing a receiver did not tell the receiver that secure the pension fund assets under custody of this bank, because these are assets outside the balance sheet of Unibank. And it created a lot of problems. So quickly, NPRA has to work with the receiver to ensure that the scheme assets are protected according to our law. So that's why I said that the best thing that has happened is the Financial Security Council, that the Minister of Finance and the Sampson they have established. But there's no ambiguity about who the power. And that's why I like when Sampson said that the trustee need to ensure fund managers take the right decision on long-term capital, because they are supposed to ensure. They are supposed that the backstop to them. They will pay out pensions, not fund managers or look, under 929, when somebody buys a unit trust or a mutual fund and is exiting, he goes to the fund manager's office and collect his money. I worked at Data Bank, so I know what I'm talking about.
Mr. Abbey.
Yes.
Thank you very much, sir. And that has been quite insightful. In order that we don't keep our people waiting, we wanted to move on to the next session, but please stay on. We've taken notice of the other questions so that we come back after the final presentation. So the next person to have the presentation is also another regulator, and it's in the person of Mr. Paul Ababio. He's the director, the Deputy Director General of SEC. And in not to waste much of the time, we'll ask that Mr. Ababio comes over, make his presentation, then we ask questions and engage further. Whilst Paul is speaking, if you have questions, comments, or any inputs, kindly write it down in the Q&A section, or maybe you can write it down when we are doing the final engagement. So Paul, if you can hear me, kindly let us hear you.
Okay. Good morning. Good morning. Can you hear me?
Yes, we can hear you, Paul.
Okay. So, David is always a hard act to follow, so you should have put me first before he's spoken. But he's covered most of the things I would have addressed. And I think I had a few remarks prepared. I'll speak to that initially. And then I think Sampson mentioned the Capital Market Master Plan. I'd want to dive into it briefly just to give people a sense of what we're looking at and the way forward for the market following the cleanup. And so I'd assume that maybe I have about 15 minutes or so, but I think we'll have a question and answer session, so I'll allow for some questions. So to the special guests, Mr. Sampson Akiligoh, Mr. Ekow Afedzie, MD of the Ghana Stock Exchange, Deputy DG of NPRA, invited guests, ladies and gentlemen, all protocols observed. 2020 affected economies around the world. There were a vortex of problems ranging from economic lockdowns to supply chain disruptions, oil price disturbances, healthcare instabilities, resulting in furloughs, salary cutoffs, layoffs, and all these had impacts on capital markets, ranging from equities to fixed income securities, commodities, and then hybrid market instruments as well. The period also witnessed greater volatility in asset classes, with some flight to safety amidst the uncertainty. Over the past 3 years, the Commission has worked on various reforms, including introducing a framework for commodities exchange, private funds, real estate investment trusts, amending the licensing requirements, and enhancing our supervisory framework, and also getting a better sense of the state of operators in the industry. By the powers invested in the Commission, we revoked the license of 53 fund managers in November 2019. Of these, 21 had ceased operations, with the remaining 32 being in various states of distress. The portfolio of these firms at the time of revocation was 8 billion, out of which about 2.4 billion, 30% was in treasury bills, banks, and listed equities. I must say that this 30% was largely pension funds. So these firms usually had their assets in other asset classes. So we've talked about the reasons for the revocation. A large part was inability to return client funds, having ceased operations, having failed to comply with our rules and regulations consistently, and despite the opportunities given by the Commission to address them, their failure to do so. The Commission also felt that these firms posed a severe risk to the stability of the financial markets and to the interest of investors. At the time of revocation, we had estimated a cost of about 8 billion. The claims we received amounted to about 12.7 billion, out of which we validated about 8.6 billion currently. Government has advanced 3.4 billion towards the payments, which commenced from October last year. The payments are through a two-tiered fund structure called the AM Fund Limited, where Tier 1 offers an immediate withdrawal of funds, while Tier 2 allows for withdrawals commencing on the first anniversary of the fund, in this case, November 2021, and then every anniversary subsequently. The intervention allowed for the preservation of investments of over 77,000 retail clients and over 4,700 institutional and corporate investors, restoring transparency and introducing greater accountability while instilling higher ethical standards through improvement of the licensing and supervisory framework. The total AUM for the industry actually grew in 2020, despite the impact of COVID. We saw a growth in pension funds. We started in the 2019 ended at 17.9 billion, ending 2020 at 22.3 billion. CISs, collective investment schemes, actually decreased from 3.8 billion to 3.14 billion, while we saw a further decrease in other funds. So these are funds not invested in collective investment schemes or CISs. from 6.5 billion to 5.2 billion. So in aggregate, funds under management grew from 28.3 billion to 30.6 billion, a growth of 8%, largely due to the pension fund growth. On the equities market side, and Ekow mentioned that the stock market had grown 36.16%. This on the back of a decline in 2020. So the pickup is much appreciated. We've also seen a heavy increase in the volumes traded on the market as well. In terms of regulatory challenges in 2020 due to COVID, we saw a reduced investor appetite or demand for shares in the stock market. Now, offers obviously exceeded buy orders, therefore resulting in downward pricing pressures. We saw companies seeking to delist, partly due to reduced investors or shareholder interest to provide additional capital. We also saw limited marketing avenues because the pandemic also led some FMCs to temporarily close offices and work from home. The pandemic has caused most firms to migrate online. Now, while this is an adversity, we see it as a positive because we have been championing digitization of our own operations, but a plank of the master plan is also improving digital infrastructure for the market. So this transition is critical. SEC staff were also impacted by COVID, resulting in limited resourcing of our own operations. We had to close for for 1 week last year. And since 2020, we're working on a shift system as well. We also started migrating supervision of companies online. And then we started to receive returns of fund managers through a new portal that we developed in-house. And that's helping us to speed up the analysis that we do and then to revert to clients on any issues of inspections that happen afterwards. Now, the regulatory framework or developments to combat the challenges. So during the year, we also issued some guidelines in accordance with Act 929 with the aim of strengthening the supervision of the capital markets. These include the licensing requirements, the conduct of business guidelines, corporate governance code for listed companies, sandbox licensing guidelines, and the guidelines on auditors and reporting accountants. One of the issues, obviously, was the quality of auditing that is done and making sure that firms that report on our regulated entities are known to us and we can hold them to account both through their entity and also directly. We gave a directive on the operation of trust accounts by market operators. And this speaks to Mr. Abbey's point on fund managers commingling client assets with their own operational assets. And this is very important. This is a plank of the fund management industry. That a fund manager's balance sheet is different from the investment portfolio it holds on behalf of clients, because clients are exposed to the performance of the underlying assets in their portfolio. Whether it is a managed account or it is a CIS or it's an SPV, all these entities are supposed to have specialized accounts for investment purposes, out of which the fund manager may take their fees and other expenses, which are measured and can be audited periodically. Additional directives we also issued in 2021 on the adoption of minimum standardized KYC forms for all market operators. We also issued a circular on anti-money laundering reporting officers of capital market operators, and then investment guidelines for fund managers. Finally, in addition to the above, we also carried out the following. We extended the deadline for submission of 2019 financials and Q1 2021. This was to allow for adequate time given the impact of COVID. The digitization of returns has also helped to speed up and the ease of submission. And then we also collaborated with the GSE to develop an OTC market to improve trading volumes and enhance investor protection for unlisted public companies beyond the GACS. And in May 2021, we launched Ghana's first capital market master plan, which outlines a 10-year roadmap of activity initiatives that will guide policymakers and stakeholders regulators, and development partners towards the growth of the sustainable capital markets for Ghana. Now, our outlook for the rest of 2021. We expect that fund managers will make adequate disclosures on portfolio compositions and performance to investors so as to guide investment decisions. We have encouraged the market to take up collective investment schemes such as mutual funds and unit trusts, since they have clearer asset structures and risk profiles. They also have a predetermined governance framework and withdrawal requirements, which for investors, that becomes a form of protection, knowing what you're getting yourself into from the outset. We also expect to see a big push in preparing additional companies to come to the exchange for listings as the business and economic environment adjusts to the new normal in this COVID era. We want to see a representation of real estate, information technology, and agriculture feature prominently on our exchanges. And we've made this on a few platforms that if you are an investor looking to get access to certain asset classes in Ghana, you don't necessarily have to go and set up a business on your own. You could also invest in the stock market, so that the stock market represents all the available asset classes. And as broker dealers, I think we count on you to do this push to support us in these interactions and to bring these companies that the funders may have in their portfolio, the banks have in their portfolios to the market, or at least to prepare them if the investor appetite is not that strong. They can look at modalities, they can look at a small raise, and then subsequently increase the capitalization they put on the market. As a commission, we'll also be leading the implementation of the Capital Market Master Plan, first with the establishment of the steering committee and a secretariat, followed by commencement of work by the working groups. So these are the key initiatives that we have undertaken over the period. I will take the opportunity. Mr. Moderator, how much time should I allocate to the rest of my presentation so that I manage?
Okay, Paul, you can make it quite brief. Then we go to the next speaker, then we will do the Q&A. So if you can summarize that quickly within a minute or two.
Okay, all right. So briefly, I'll share briefly. So the vision of the master plan is to have a deep, efficient, diversified, and well-regulated. Is my screen being shared? I don't think it is.
Paul, we can see your screen.
You can see my screen, okay.
Yeah.
Okay, yes. So we want to have a diversified capital market, which is well-regulated with a full range of products. And some of the products we are looking at boosting, obviously we have real estate investment trust, we are looking at repos, we're looking at angel capital, we already have venture capital, but enhancing that and enhancing the value chain around that is important. The commodity exchange was launched in 2018, but improving that is also critical. There are 4 pillars to the master plan. Those who are not there at the launch, this is a good chance to catch up. But we're looking at creating diversity of investment products and liquidity of securities markets. We're looking at increasing the investor base, strengthening infrastructure, and improving market services, and then improving regulation, enforcement, and market confidence. We map this obviously to national priorities and then sustainable development goals for the economy. We've talked, Sampson mentioned the credit rating agency, it's important. Liquidity in the government bond market is also critical. And then the market makers, we always talk about liquidity. We want some broker dealers to be designated as market makers. We are now developing the framework around that and the rules that will apply, given that we have to have some exemptions from the current regulatory framework. On the investor base, obviously having CIS is important. And we mentioned the number of people in CIS currently is quite small, so we want to deepen that. We also want to boost the international views on the market as well. And then on infrastructure, demutualizing the GSC, bringing in CPDs for intermediaries beyond just the basic training. And then we're looking at fintechs as well as an area where the Commission sets up a platform for regular engagements on innovation and adoption of technology. On the regulatory side, SEC, financial and human resources are important. Addressing the cleanup was critical. And then having an investor protection fund is something we are still working on. Okay. Let me just briefly, maybe I think part of what we need coming out of the cleanup is excitement. And what we see from where we sit is that Ghana has a huge potential. One, as a regional hub, Africa presents some opportunities that we need to be positioned to take advantage of. But even as a stable democracy in the sub-region, as a vibrant private sector-led economy, we want to see a lot of capital raised on the market. We want to also see our fixed income market play a big role. We mentioned the banks, for instance, have not listed, are currently don't have any bonds on the fixed income markets. And the issue I've often heard is that the pricing demanded on the bond market is higher than what they get on deposits. Now, clearly, if pension funds are doing fixed deposit with the banks, pricing is a big part of the pension funds considerations. And David mentioned that the lack of liquidity or lack of the pricing issues, given the restructure has happened. However, if a bank issues a bond, that can be priced and can be traded on a secondary basis. Because if a pension fund has 10 million cedis with a bank and they need to withdraw it suddenly, the bank faces a liquidity crisis. Whereas if it's a bond, which is being used to finance real sector projects, right? Then the withdrawal or a trade does not necessarily affect the bank's balance sheet. The bank can continue operating without having to go to Bank of Ghana for liquidity support on the back of that. So if we have these frameworks in place, then the bond market should even be more vibrant, should be larger than we are seeing now, because the banks are currently relying on short-term funds from our perspective. Okay, so at the end of the day, we want to see Ghana become a frontier, an emerging market. So we are classified as a frontier market now, and that has implications. That has implications on the pricing government gets when it goes to issue Euro bonds, even for our domestic currency, even local investors' expectations, because the risk premium is quite high. When foreign investors come into Ghana, they're expecting sort of an 8% premium to their risk-free rate. Then they take into consideration depreciation and the liquidity factor. Now, if you're an emerging market, lots of index funds, global index funds would hold our securities. They would also want to have it for pension funds and sovereign wealth funds as well. So very briefly, we expect that we'll have the criteria to be classified as an emerging market. And that means that we have to have a few very large, well-capitalized firms on the market. And the investable market cap should be about $6 billion to be considered for that. Times 6 is about 36 billion cedis. And so that's a hurdle rate that we need to meet over the next 5 to 7 years. And then there are some criteria that are considered for emerging markets. One is the treatment of minority investors, whether we have restrictions on foreign ownership, whether we have a foreign exchange market, which is also developed, and then whether there's competition among brokerage firms, and the brokerage services are also high quality, whether we allow stock lending, and then whether we allow short sales and derivatives markets. So there are a few initiatives that the master plan envisages, which, if taken into account, will make us ready for reclassification as an emerging market. And there we also see huge potential for Ghana and for the capital markets arising out of that. So with that in place, I think I'll end my remarks here, and then we can have the next presentation. Thank you.
And I think across the two regulators, the team that thinks through is in order for us to move from our current frontier market to an EM, keywords like automation, improvement of the product universe, and liquidity, then also enhanced regulation and enforcement. These seem across as the key ones on our journey to becoming an emerging market. So what we are going to do next is Emmanuel will introduce the next speaker. Then thereafter, we will take the questions. Because we are hard pressed for time, this is how we are going to approach the Q&A. We will, when the presentation is done, we will come back to read out the questions. We will indicate which speaker the questions are for, or if it is open to the other speakers or even audience, we'll let you know. Then if at the end of that presentation, anybody in the audience wants to speak for a comment or a question, the rules are you click the hand button so that we are able to identify you. Then we move on. So I would like to hand you over to Emmanuel so he introduces the next speaker.
Right. Thank you, Nana. So after having listened to our two important regulators on what the understanding of the two issues that have hit the market and what they are doing in the transition stage, we'll move on to another key player on the pension space, which is the in the trustee space. So we'll call on Mr. Nana Wiafe Boamah, who is the Chief Investment Officer of Access Pension, for him to also give us a perspective from the pension trustee view on what we've discussed so far. Mr. Boamah, can you hear me?
Yes, I can hear you. Can you hear me, please?
Yeah, I can hear you. Kindly take over, please.
Sure. Thank you very much. I would share my slides briefly. All right. I guess you can see my slide.
Yes, I can see your slide.
Well, thank you very much. All right, so thank you, very much indeed for the opportunity to speak on the topic, reliability in times of uncertainty, the need for synergy in building a resolute and efficient investment portfolio. I strongly believe this topic is fitting for such a time like this, even as our industry is still reeling from the sector-wide cleanup exercise and also COVID-19. And I'm honored to be sharing my thoughts on the topic. I think and I believe building a resilient investment portfolio.
Sorry, Mr. Boamah, I think I just got the alert that we can't see your face properly. So if you can lean back a little bit. So
okay.
You can see your...
All right, sure. Is it better now? Good.
Yeah, that's better now. That's better now. You can proceed, please.
Thank you. All right, sure. So building a resilient investment program requires discipline in portfolio management, of course, buttressed by a strong ethical foundation. So my presentation today will touch on the processes of building a resilient portfolio through optimal asset allocation. And I'll conclude with the core ethical principle that every investment organization and asset owner should be guided by in their fiduciary role. I'm sorry, the presentation will be a bit, academic. I will take you to my days when I was a TA at Legon. So asset allocation is a strategic and often the first decision in portfolio construction. And because it holds, that position, it is widely accepted as the most important and therefore meriting careful attention. I believe no one, be it an individual, a pension fund, whether defined benefit or defined contribution, a central bank managing a country's reserve, an insurance company, or a mutual fund can build a resilient portfolio without a well thought through asset allocation. And why is asset allocation so important? Firstly, strategic asset allocation helps specifies the investor's desired exposure to systematic risk. And since investors cannot avoid systematic risk, asset allocation help investors determine the kind of risk they want exposure to. So that is very, very important. And once you have determined the kind of risk you want exposure to, strategic asset allocation indicates the appropriate asset mix to be held under long-term or normal capital market condition. So when all is said and done, you'd realize strategic asset allocation actually determines about 95% of investors' return. The remaining 5% is either through timing of security purchases and sales and security selection. This result should tell us that as investors, we need to get our asset allocation right, and the rest will take care of itself. Without a well thought through asset allocation, like I said before, you can't build a resilient portfolio. Now, how do we determine strategic asset allocation? In strategic asset allocation, an investor's return objective, risk tolerance, and investment constraints are integrated into a long-run capital market expectation to help establish what the IPS permissible asset class should be. So from the graph or from the chart, you see the yellow boxes, to your right, actually represent the investor's circumstances and situation. So take a defined contribution pension fund, for instance. The starting point of asset allocation is to determine what the size, right, of the fund is, the characteristics, of the members of the fund liquidity need and risk attitude. We then run these assumptions through a risk tolerance function to determine what the fund risk tolerance is. The green box represents capital market condition and expectations and how they affect risk and return. Once you have the criteria for capital market assumption and the investor's unique circumstances, all sorted out, it is run through an optimizer, right? That helps determine the invested asset mix and therefore return. The bolded red line, shows that these processes need constant feedback to make it efficient. And why is that so? We all know capital market conditions, for instance, do change. We all know the expected return and risk on asset classes, do change. On investor circumstances, also does change. So to actually, fashion out a very, comprehensive asset allocation that will stand the test of time, you need, that constant loop. Over here, I'll take you through, how we, determine our asset allocation. So I show, here how asset allocation determined using the mean variance optimization technique, right? The key input required here are the asset class historical return, and that is what you see, to the left of the slide. So for a period of 17 years from 2000 to about 2017, the returns you see are the returns on these, asset classes. So the 91-day, return about 19.81%, the GSC about 19.67%, ex-dividend, and corporate bond about 24.21. And then the 2 years about 80.5. Now, this return and standard deviation input, right, are used to derive the asset covariance matrix, which is shown on the right. The covariance matrix actually shows the extent to which asset moves together. And if you look closely at the table, you'd realize equity has negative covariance, right, with the other asset classes. This might perhaps tell us that equity in a multi-asset portfolio is a very good diversifier. After the returns and the covariance metrics are determined, we run the output through an optimization to determine what the optimal asset class for a multi-asset portfolio should be. So running the mean variance optimization and assuming equally weighted asset class. To the left of this slide, you see an equally weighted portfolio where we have 12.5% invested in all of this asset class. In the strictest sense of the word, we all know the 92 bills, 182 days, 1 year, 2 years, all belong to one particular asset class. But for the sake of this discussion, let's assume they are all independent asset classes. So running the output through this optimization, you realize the expected return for a portfolio that is equally invested in this asset class comes to about 19.7%, with a standard deviation of 2.6 and a shortfall ratio, which is our indicator of a mean variance optimal portfolio at 1.06%. Our mean variance optimal portfolio, however, as you see on the right of this slide, recommend that we park about 98% of our portfolio in corporate bond. And the reason is corporate bond offers, the highest, return from the historical, numbers we look at. And that portfolio would actually defy the principle of diversification. The undiversified portfolio from the mean variance optimization highlight the most important shortcoming, right? With optimization, beside the fact that the outcome is extremely sensitive to return assumption. Now, the shortcoming with the mean variance optimization is somehow corrected by the risk-sampled efficient frontier. With a risk-sampled efficient frontier, we run different simulations to determine the efficient portfolio that is expected to represent the available asset class. When that is done, the result is then presented to the board of trustees, right, or the investment committee, who will then use their judgment and experience to help guide in coming up with the optimal asset allocation. So in a functioning investment organization, and don't forget, we are talking about building resilience in our investment operation in the wake of what has happened. So in a well-functioning investment organization, you expect the investment staff to do this analysis. And then the result is presented to the investment committee, right, or the board of trustees, who come in with their experience, their judgment to help in settling at a fairly optimal asset allocation, which ultimately goes into the firm's IPS. So at Access, the investment staff do this exercise, and then we present, the result, right, to our board of trustees, who are made up of 2 CFA charter holders, 2 chartered accountants with wealth of experience in investment management, an experienced business executive who has years of portfolio management experience, and an HR practitioner. Now, if you look, closely at this table, right, you'd realize the most efficient diversifiable asset allocation has equity allocation of about 20%. Again, of course, the board of trustees, can use their judgment to adjust, for this based on the risk appetite of the investment program. It is very, evidence, over here that rarely, you cannot build a very efficient investment portfolio in a multi-asset setting without allocation to equity. So if you count, from the green highlighted cell, the second allocation after the green highlighted cell, you'd realize 10% allocation to 91 days, 10 to 182, 20 to equity, 20 to corporate bond, and that generates an expected return, right, of 19.3 for our portfolio, a standard deviation of about 3.9, and a shortfall of about 1.08, which is the highest amongst our diversified, portfolio. So a few thoughts here before we move on to the last section of my presentation. First of all, I think you cannot build a mean variance portfolio with a multi-asset investment mandate that will deliver alpha to your investors without equity. The general aversion to equity, in my view, is driven by what behavioral economists call the recency bias or availability bias. So recent events in the market has driven most of our investors out of the market. As investment professionals, and I guess this particular webinar is targeted, to investment professionals. It is our role to understand these biases, overcome them personally and collectively as investment committees or board of trustees, and then educate our members and investors, hoping they would overcome these biases so we can make the most optimal allocation for our funds. Secondly, this result would even look better if our equity allocation are in solid companies with consistent growth in revenue and earnings, have strong and resilient balance sheet, low debt, high asset turnover, and generate higher returns on equity and investment capital. We use the broad equity index to arrive at our allocations for our optimization. Can you imagine if, we had limited ourselves, to the best 5, 6, picks over the years? The result would have been better. And then lastly, my comment over here, Benjamin Graham, the father of value investing, said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. As portfolio managers and investors, right, our focus should be on uncovering value in strong companies that will stand the test of time. Short-term volatilities, in my view, in your well-researched pick, should be an opportunity, to increase your margin of safety by buying more at a lower price. Over the long term, when companies perform well, their share price do so. So this should perhaps reduce, the apathy, to investing in equities. Now to the second leg of my presentation. I believe every investment organization must be guided by strong ethical compass. Trust is the bedrock of our organization, right, and industry. And to emphasize, not returns. What matters in this industry is trust and not return. So Warren Buffett said, you would never know who is swimming naked until the tides goes out. And when the tides indeed went out in our industry, we saw the firms that were really swimming naked. So as asset owners, as investment managers, as trustee boards, as investment committees, we should be guided by these fiduciary responsibilities in our roles as investment managers. I would briefly read them. And if we were together in a room, I would have asked, all of us to read these together. So I'll start. Number one, we are supposed to act in good faith and in the best interest of our plan participants and beneficiaries. We are supposed to act with prudence and reasonable care. We are supposed to act with skills, competence, and diligence. And I guess this should inform the kind of people we want to appoint, right, on our board of trustees. And this cut across both the corporate trustees and employer-sponsored trustees. We need people of skills and competence to sit on the board to make decisions for the members. Number four, we are supposed to maintain independence and objectivity by, among other actions, avoiding conflict of interest, refraining from self-dealing, and refusing any gift that could reasonably be expected to affect loyalty. And I guess the era of taking, kickbacks, to place monies in financial institutions are long behind us. Number five, we are supposed to abide by all applicable laws, rules, regulations, including the terms of the plan documents. And we are blessed in this country to be regulated by the MPRA and the Securities and Exchange Commission. And I believe if we abide by the law they promulgate, to lead these industries, we would all do fine. Number 6, we are supposed to deal fairly, objectively, and impartially with all participants and beneficiaries. We are supposed to take actions that are consistent with the established mission of the plan and the policies that support the mission. We are supposed to review on a regular basis the efficiency and effectiveness of the plan's success in meeting its goals, including assessing the performance and action of plan service providers such as investment managers, consultants, and actuaries. Number 9, we are supposed to maintain confidentiality of plan participants and beneficiary information. And lastly, we are supposed to communicate with participants, beneficiaries, and supervisory authority in a timely, accurate, and transparent manner. And I'll dwell on the number 10. It is amazing finding information about the various schemes we have in this country. Most of us do not publish our accounts. All we do is to submit the account to the regulator. But I guess in an industry that wants to transition, from the headwind we just went through, transparency in communicating schemes performance should be paramount. Usually, I like to end my presentations with parting gifts. And my gifts today are these books I show over here. As investment professionals, our level of knowledge and insight is positively correlated with the returns we deliver to our investors. And I believe, if you would avail yourself to these books and then immerse yourself in it, you would thank me later. Thank you very much for paying attention to this presentation.
Thank you very much, Mr. Boamah. And this has been a very good discussion, even though time is fast spent. So we will dive straight into the Q&A session where we're going to encourage our audience to interact with our speakers. And, so we have a couple of questions here that would be directed to the various speakers. And I'm going to start from the last speaker we just heard from, Mr. Boamah. From your presentation, what I got from it, on my personal view, was you really had a fair idea, you have a good idea of how to achieve the optimal portfolio. However, it looks like there's very strong appetite, which as you said, to achieve the optimal portfolio, you need to have some good amount of equities to really achieve a diversified portfolio and to achieve the target return and all that. But then there seems to be an apathy on fund managers constantly, year in, year out, on taking positions on the equity market. I don't know if you can speak more on that, what the issue is in relation to that.
All right, thank you, sir. So I think the starting point is how, the fund managers arrive at their investment policy statement. Honestly, if we hadn't gone through this rigorous exercise to determine our investment policy for our schemes, we would have been also very defensive towards the buying of equities. But because of this exercise that we went through, I am assured that in the long term equity does pay off. Now, to our fund managers, I would say, I say this privately, and I guess, it is befitting, to, voice my opinion, publicly. I think most of them don't have inverted comma balls, right, to defend, their investment choices to the board of trustees. And that is why we are in the situation that we are in. That is one. And secondly, I don't know, what kind of exercise, they go through in advising, what an optimal asset allocation is. And I guess, if they would sit back, reflect on capital market expectation, historical returns of the various asset class we have in this country, they wouldn't, have problems allocating between 5 to 15% of the investment portfolio, to equity. So it boils down to the fund managers. I'm speaking from the perspective of the trustees. Guys, it is not the trustees. If you come with your equity picks, well researched, and then you make a case why we should buy equities, we will not stop you, especially if your investment policy statement makes room for equities allocation. So I think that is it. The responsibility, falls, squarely on the fund managers. They can deny it, but then it falls on them. Thank you.
I guess as a brokerage firm, what we can do to support them in increasing their picks on equities is maybe we can also help them with research reports on various companies that are listed. So fund managers, you can always hit us up if you need support in that direction. I'm going to move on to the next question, which will go to Mr. Abbey from MPRA. There was a question on, someone wants to know when, sorry, let me take this. Okay, right. So I'll move on to Mr. Abbey with governance, and someone wants to know with the financial reforms hitting our markets, and a lot of the concerns we heard from the report out there was bordered around corporate governance or governance of most of those fund managers. So they want to know, what are the policies to guide governance moving forward? Yeah, and sorry, Nana will add another question to it so you can take the two of them.
Yeah, so Mr. Abbey, there's another question here for NPRA, and they are asking about your 2020 annual report on your website, when you're going to publish it. And the other follow-up question was also,
I can't hear.
Oh, I was on mute. Hello. Please, did you hear me? There were these two questions.
No, I didn't hear you.
Oh, sorry. I think I was on mute. So the questions were, when is your 2020 annual report going to be on your website, going to be published on your website? And the follow-up question was, are you going forward, are you going to improve the frequency of the statistics that you publish on your website? So these are the questions for NPRA.
Okay. And I think the moderator was speaking as well. What was his question?
I'm sorry, but yeah, my question was on that bordered on governance of most of the pension funds. And I think this is coming on the back of various concerns we had from the report on the funds that went down or the banks that went down. A lot of them bordered around governance of those institutions. So someone wants to know, are there any policy guidelines moving forward that is going to ensure that governance of these pension funds and trustees are robust enough to withstand further challenges moving on?
Yeah, I think during my presentation, I made it very clear that the NPRA, under the guidance of the FSC, has come out with a guidance code, which we are yet to issue to the market. So across all the 4 financial security system regulators, governance is key. I know Bank of Ghana have a governance regulations, SEC, NIC. It's a requirement that we need to have guidelines on governance. And I believe that the NPRA, the way our governance structure of schemes is done, you realize that besides investment risk, we didn't have any governance risk. Similar to what Mr. Ababio was talking about, we have a predetermined governance framework a predetermined governance framework where that's what I was trying to explain, the role of the trustee, the role of the fund manager, the role of the custodian. So when even the Unibank went down, for example, as a custodian bank, the only exposure to pension schemes were the investment decisions that they have taken towards Unibank as an issuer and not Unibank as a custodian because of the related party. I think Regulation 16 talks about conflict of interest, and it's very broad. So if Unibank as a custodian, the asset that Unibank is holding should not include Unibank fixed deposits. So when Unibank collapsed and we spoke to the receiver, we were able to secure the assets of Unibank, which were off their balance sheet because they also had a custody license. But what became a problem that we need to manage with CBG was the fixed deposit that they have bought. So I believe that we have a very good governance framework. And it is very clear in our law that pension funds in the course of liquidation cannot be encumbered when you are a custodian bank. But if they are bought fixed deposits and it is a subordinated debt or whatever it is, then when they are sharing it, that one they are on best line. But if you are a custodian bank, the asset you are keeping, pension asset you are keeping in custody for pension fund cannot be encumbered and be added to the assets of Unibank for distribution. So the pre-governance framework we have in pension is very key. And it's similar to what pertains at 929, where the fund manager is supposed to be independent from the custodian, a fund manager of a mutual fund. And then a fund manager of a unit trust also should be independent of the trustee. So these are supposed to help mitigate against some of the shocks that we experience. And I can say that besides investment risk, because we cannot prevent investment risk, we should all go and sleep and get guarantees from government. But since we cannot guarantee investment risk, and I like Mr. Boamah, we are saying that the investment decision-making process must be thorough. It must follow a fiduciary code. And as is, I think Mr. Boamah works for us, they have in-house investment experts that try to engage with the fund managers to ensure that the investment decision-making process is very, very sound. If we don't do that, and we as trustees only depend on the external fund managers, and that is where we have this conflict, because the guy that you are selling the investment to, he doesn't even understand what you are talking about. Look, managing funds for uninformed investor or service provider or a boss is terrible. It's terrible. When we were managing provident funds, one of the worst people you can have are the in-house trustees who don't understand what you are doing. That was a fund manager. When you go, they will compare your investment decision to the price of cement, as if you can't buy cement with their money. So let us ensure that the governance framework that has been done under the law works. Now, the annual report, as I speak to you now, I am on a retreat in Koforidua working on the annual report. We are looking at the audited scheme report, which came late. We nudge, we try to use sanctions and things, but we got them late. So we've moved the whole MPRA to Koforidua to review the findings we saw in the annual report by the auditors and things, and then validate the figures that we are going to put in our report. So we will get the improved frequency of statistics as well, because currently we have the quarterly pension digest that our corporate affairs unit publishes. We have a lot in-house that you can always come for some. We post them on our website as well. But our annual report will come out because we got some of them. In the past, we were not using the audited report. We were using the returns that they sent to us on the monthly and quarterly and half-year basis. We aggregate them and then we use them. Because a lot of the time, some of them delay in bringing the annual report and they will be asking for extension. So if you have you have 213 schemes and then you get 100 audited accounts by March or April, you can't make any meaningful use of it. So we are encouraging the trustees here, the farm managers here that, look, when you bring your report early, we'll be able to go to work and then we will give you the information you want. We regulate the industry and you regulate the schemes. So let us work together. Give us the scheme information so that when we aggregate it, we'll give you the industry information. It's as simple as that. And as I speak to you now, I mean, Kofodio are working on it. So that those are my answers to your questions. Nana, you are still muted. You are still muted.
Okay. Can you hear me, sir?
Yeah, I can.
Okay, thank you very much. And so we have some few other questions here. I would ask, then Emmanuel will ask, then it will be responded from the speakers. So it will go to Paul. Please write it down. Then part will go to NPRA. So Mr. Abbey, please write yours down. When Paul speaks and Nana Boamah speaks, then you also answer your question. Apologies, we have to do it that way because of the time constraint. So SEC, there are three questions, but the same question. They are asking that approval of collective investment schemes. There have been applications for close to a year and they've not heard from you. Nana Boamah, the question is, based on this, your excellent presentation and your appreciation of the market and the opportunities available as against how the assets are allocated. In your position as a trustee, or at least from the trustee fraternity, are there no ways that you can question the fund managers as to why they are sidestepping the available opportunities? And there was another question that, is it not the case that the nature of SLAs between fund managers and trustees make the perspective too much of a short term? Then now to the MPRA question. Going forward, participation, as in bringing people into the pension regime, how is it going to be like? Because there's a report from IFC that indicates the top 5 countries with pension funds. And this even excludes South Africa. Unfortunately, Ghana is not in the top 5. It has countries that are on the street. We would have said that these are our type or our size. It has Kenya, Namibia, Botswana, and all that. But their AUMs are too much, are way higher as compared to ours, averagely 40% to GDP. But in our case, even during Sampson's presentation, he made reference to the fact that pension fund AUM is just around 15% of the GDP. So what are the ways to improve it, and if there are any timelines? So Ima will also ask the questions, then Paul will answer, Nana, then Mr. Abbey.
Right. My question goes to Mr. Boamah. An audience wants to know whether corporate bonds are truly safe, or is it just a case of chasing yields? He wants to know your take on that, because and I think he added that have there not been any defaults on the market? I think there have been stories of 1 or 2 defaults, but he wants to know if corporate bonds are really safe. Then another question to you, the person wanted to know from your presentation, is the return, price return or total return for the equity return you showed on your presentation? So I think we will have Paul go first, followed by Mr. Boamah, then Mr. Abbey will come after.
Okay, I think for the CISs, we've taken a note of the question. The person affected, if they have issues, oftentimes what we get is that people bring incomplete applications. They are reverted to, and it takes a while for them to revert. So that's one. The other might be that if there are ongoing issues with the firm, and I think this person is saying there are no issues, we would want to be clear on what the issues are before we go ahead to give a CIS license. So that's one. But for those who have pending applications, send an email to info@sec.gov.gh, and then we will pick it up from there. I will get that email directly as well. And so we will pick it up from there. And I think I've noted that some people bring applications, and if they're not getting, they don't follow up. An email, a formal email, a formal follow-up. Sometimes you call the account holders, but you can still escalate to the regulator. Letters are typically addressed to the Director General. So if you send it to info, we will all get it and we will act on it. So that's our commitment to you. We typically look at a 60-day turnaround on these applications. We're also looking at an online portal where when people apply, they can see where it is in the process. So that when we refer to you and you have a pending letter, I've seen a case in point where a fund manager was following up, but they hadn't really responded to our comments to them. So it goes both ways. I think just follow up with us on it, and then we will work hard to address it going forward.
Yeah, so we'll have Mr. Boamah answer his questions.
All right, thank you for the questions.
Sorry, Mr. Boamah, I think you are muted, so we can't hear what you're saying.
Sure, sorry. So I think the first two questions are a bit related, so I'll take them together. The one on the SLA being short-term, and if we can question our fund managers when they sidestep our process. So, again, I could only, answer with an example, from Access. The management of Access, did well, to lay a solid, foundation in building a very well thought through investment organization. So there was this fund manager we had, whose mandate, was equity. And he kept, doing fixed income because he wanted to show, good returns. This was during, a period where the market, was really, bearish. We gave, a warning. The fund manager didn't heed because he thought we were short-term. Another warning, he didn't heed. And guess what? We moved on, from him because, he just violated our IPS. Returns were good. We were expecting negative returns on that particular, portfolio. He was showing positive return, but then we sacked the fund manager, among other things anyway. So yes, I get, this tussle between, long-term and short-term. But then again, the fiduciary responsibility, lies with the trustee, and the trustee should ultimately, do what is best for the scheme and not for them, right? There are some trustees who are, scared of equities, again, because of the recency bias I spoke about. Some of them invested in CPC, in Anglo Gold, in Clystol and Transol, and because of that, they don't want to hear anything about equity. But once you are on the board of trustees representing hundreds and thousands of people, you need to move beyond your personal preferences and do what is right for your members. In terms of whether we are able to sidestep, the process, ideally, again, I'll speak for Access. We don't naturally interfere in the decisions of our fund managers. However, I mean, we hold them accountable for one, performance, two, I mean, governance, three, and whether, I mean, they are doing, I mean, what we ask them to do. And again, I mean, to also emphasize your short-term, long-term, I don't know, I mean, if there's any fund manager here who has been sacked, I mean, for delivering, I mean, bad return. I don't think it happens. I mean, people would sack you, I mean, when you are engaging in something, I mean, you know, shady. So this long-term, short-term thing, I mean, I think it is more of the mind. It is a perception. I mean, do, I mean, what is right by your trustees, do what is right by your beneficiaries, and then everybody will walk, I mean, happy. On whether corporate bonds, I mean, are truly safe, again, from the result, I mean, I shared, I mentioned clearly that after the investment staff present this to our board of trustees, they come in and use their judgment and experience to make adjustments. So even though, I mean, the allocation recommend 20% allocation to corporate bond, the question we have to ask ourselves is, I mean, do we even have, I mean, that deep, I mean, market to accommodate 20%, right, of allocation? The answer is probably no. And if we have, I mean, those, I mean, are the issuers, I mean, that, I mean, quality, that is also, I mean, the question, I mean, experience and judgment comes in to set, I mean, what is optimal for the asset class called corporate bond. But then I cannot tell you that they are, I mean, safe or, I mean, not safe. It depends, again, on the risk appetite and what the investment analyst sees in a particular issue. In terms of default, yes, there have been, I mean, default, but for one of the defaults, I know, I mean, the Ministry of Finance, I mean, stepped in and then made, I mean, investors whole. So those are some of the risks, I mean, you are confronted with in investment. Let me be clear. I mean, you can't get everything right in your investment program. I mean, your responsibility as an investment manager is to get most things right, not all things right. And when you get things wrong, own up to your responsibility, right? And learn from it and make better decisions, I mean, going, I mean, forward. On the price return and the total return, I think I answered, I mean, the person who asked the question. I used price return for my analysis. If I had used total return, the result would have even been better, I mean, for, I mean, equities. So that probably summarizes my answer to your question. Thank you.
Responses. So we'll move on to Mr. Abbey on the question directed to the MPRA.
I think good afternoon. Just to add something to what Boamah said, section 153 is titled Investment Policy, section 153 of the Act 766. And I will encourage fund managers to demand the investment policy statement of their trustees. Look, we have a whole schedule under regulation, the regulation 1990, that I think schedule 2, that establishes the investment management contract between a fund manager and then a trustee. And section 153 of the law clearly states that a trustee shall have a statement of investment policy which shall be reviewed at intervals and on conditions as may be determined by the board. Now, a statement of investment policy in relation to a trust scheme is a written statement of the investment principles governing decisions about investment for the purpose of the scheme. The trustee shall comply with prescribed requirements before preparing or revising a statement of investment policy. And then listen, number 4, 153.4, a statement of investment policy shall be in the prescribed form and include 1, the investment objectives, 2, policy as to the kind of securities and other assets that may be acquired, C, policy as to the balance between different kinds of securities and other assets, D, risk in implementing the investment policy, and E, return expectation in implementing the investment policy. Now, number 5, and that is what is important here, where in case of a trust scheme, a statement of investment policy have not been prepared by the trustee or maintained, reviewed, or revised, or the trustee has not complied with the obligation imposed on them under subsection 3, the trustee is liable to a penalty determined by the board. So when I hear SLA, when you look at Schedule 2, or Schedule 1 of LI 1990, the investment management contract is there. And inclusive of the investment contract is the 153. So when you are taking on a fund management function, you need to get the investment policy, because if you don't, then all the things that Nana Boamah is saying, and like Nana Boamah said, he is taking her to school and speaking grammar. But if Nana Boamah is not speaking grammar, the law is very clear on the side of the fund manager that when you are pitching for business, look at the investment policy statement of the trustee. That will tell you the way they will treat you. Because once you have the policy, even the 4E, it's even talking about the expected returns. So you have a benchmark and you know what you are supposed to do. So it cannot just sack you. If we sack you against the policy, the MPRA is there. And as I speak, we've never had fund managers coming to tell us that the investment policy guidelines of trustees are short-term and they have sacked me. It's all perception. But hold them to 153. And I always tell people that, especially the fund managers and the custodians who are licensed under 929, they don't spend time on 766 and 883 to upgrade themselves. If you want to stay in 929, stay there. But if you want to come into 76 and 883 in the patient's suite, make yourself appraised with the law, so that when the trustee is messing you up, you will stick the law in my face, and then you will see what I will do. Stick the law in my face and see what I will do to that trustee. But you are there complaining and like you are kids. Let's stop this thing. Do you have an investment policy guideline that is guiding your investment decision making? If it is yes, that should have been done before you even go to the market to buy the securities. And is the trustee adhering to it, or is just changing it left, right, and center? Tell us, and then see what we will do. Now, Nana, to your question, the AUM, the increment of the AUM is gradual. Look, Ghana has one of the highest contribution rates of 35%. If you add tier 1, tier 2, tier 3, the tax-free contribution rate of emolument is 35%. The investment returns of pension funds is tax exempt. The benefit that is paid to Ghanaians pensioners is tax exempt. This cannot be matched in any country. We are members of the International Association of IOPS, International Organization of Pension Supervisors, and I'm saying this on authority. It is only Ghana that we have EEE in terms of tax status of the contribution, of the investment, and then of the benefit. In many countries, the benefit is taxed. In many countries, the investment returns are taxed. But in Ghana, it's free. And this is the way government is trying to make sure that long-term capital are mobilized for national development. And nobody should get that wrong. We cannot teach them how to invest. But I believe that 153 is very clear on the policy guideline. And they send out the policy guideline. And it doesn't reflect short-termism. We license them and we look at the investment policy guideline. You can't be a trustee without an investment policy guideline. Maybe the fund manager engage them and they change it. So I believe that these two go hand in hand. One other thing we are also doing is to increase penetration and coverage. So as I speak to you now, last week we were at Asesewa. We will go to Yeji, Tetteh-Amey, all trying to penetrate the informal sector so that we can bring them on board to increase their contributions, which will become investment, and then even the benefit that are paid out can still be invested in the economy. SNIT as a corporate trustee managing the first year pays out about 2 billion Ghana cedis annually to pensioners. The tier 2 and tier 3 privately managed schemes, which I think their trustees are here, just started paying last year. They started paying from the mandatory schemes last year. So they had an accumulated fund, that's the 22 billion as at December 2022. And all these things, we are 15% of GDP. When the NPRA started about 10 years ago, we had nothing. So let us continue the education. Let us continue with the digitization drive that the Vice President have embarked on, which the NPRA is supporting through the use of the National Identification Number as against NIT number or the pension number. When that is done, you will be there. And then when the SIM card registration also using national ID is done, you'll be there. Your pension will come on your Momo for you when you retire. And then you'll be there. We will enroll people through the digital means. Currently, we have one scheme that is using MTN to enroll people through mobile phones and mobile money. And once these digitization processes and the payment systems and all those kind of things is completed, you realize that coverage will go up. There will be more contribution, which is the bloodline of any pension schemes as deposits are to banks. We will raise more money and then we will get there. But don't forget that as the GDP bases are also going up, it will drop our percentages. But we will work very hard so that regardless of the rebasing, our percentage will still be high. So Agyei and Sampson, no worry, we'll sort you out.
Okay, all right. Thank you very much, Mr. Abbey. Is there any other concerns from the audience? Any questions? If not, we would proceed to bring the today's series to an end. And I have to acknowledge that Dr. Claudia Kuma from the Research Department of Bank of Ghana joined. Thank her for her time. Thanks also to Mr. Enoch Mensah, board chairman of Blackstar Brokerage, and Ms. Isabella Fumensa, also a director at Blackstar Brokerage, for joining. And also thanks to all the fund managers who have taken their time to listen to this fruitful discussion. And importantly, thanks to our speakers who have shared this thoughtful insight with us. I will hand over to Nana Agyei for him to give us the closing remarks, then we can bring the program to an end.
Thank you, Emmanuel. And I say more. All that we will say is Blackstar Brokerage is grateful for your presence. It's been a very good forum, and as a community, at least in the investment money. Hello, can I be heard? Yes, so we are very grateful, and I think it's been a very good exercise for the community. We were also blessed to get perspectives from the ministry, from the stock exchange, from trustees, from regulators, and also on the engagement section from the various institutions. And the takeaway is we all know that there is the need to move from where we are to the next level, because we are all optimistic that, yes, indeed, there's been challenging times, financial sector reforms, COVID, but we all agree that we are transitioning. So whilst we are transitioning, we are very hopeful and we work towards such that Ghana capital market will move from a frontier market to an emerging market. Whilst we are doing this, a lot of focus and the attention will be on automation, improving the products, the asset class universe, improving liquidity, improving professional ethics, and a whole lot of others. And we all know that we need to improve those things so that we can work to build our country just such that if there are any other challenges, our investment strategy will be so resilient that it can withstand any kind of challenge, be it COVID or be it financial sector reform. Thanks so much. And we will be happy to have you tomorrow for our section that is being held for the institutions that are being regulated by BOG, with the exception of banks. So we are going to host the savings and loans, the rural and community banks, as well as the microfinance institutions. So thank you, and thank you for being part of the first BSB webinar series. Thank you.